Hello, and welcome to our article audio series, where we feature some of our top human-written blog articles from FactSet experts on insight.factset.com and narrate them with an AI voice so you can listen on the go. This episode is about our copper Capex watch, authored by FactSet's Banu Nadarajah, FactSet research analyst for mining and metals. Copper has pushed into fresh record territory, briefly breaking above $14,500 metric ton earlier this year, and, despite some recent softness, still trades near $13,500 metric ton, approximately 8% above the prior year-end record close. The price action is signaling a clear message: more supply is needed, and there is currently a green light to build. Within the mining world, capital efficiency is the defining axis of value creation. With M&A markets running hot and developers racing to advance projects, this report attempts to cut through the noise by asking a single question. Does building new copper capacity make economic sense when proven production is available to purchase through M&A? The answer, using a single common metric applied to both options, is nuanced. We calculate Capex intensity by dividing initial Capex life of mine average annual production. We identified 96 active pipeline projects with studies filed within the last 5 years and observed a median build Capex intensity of $18,048 per annual ton of production, or TPA, and a production-weighted average of $25,228 TPA, across 88 M&A transactions identified completed since 2000, with an aggregate enterprise value of roughly $245 billion, involving the acquisition of either a single copper asset or a portfolio of copper-producing assets. The long-run acquisition median observed was $17,629 TPA, which is near parity with median build intensity on a headline basis. But the recent cycle tells a different story, as the 3-year rolling median acquisition intensity has risen to $26,035 TPA, roughly 45% above the median build intensity observed. Let's now turn to build Capex intensity, beginning with the cost to construct new copper. Across 96 active pipeline projects identified with published development studies from 2021 or later, representing approximately 5.3 million TPA of potential new annual production capacity, and roughly $132 billion in aggregate capital requirements, the observed median build Capex intensity is $18,048 TPA, and the production-weighted average is $25,228 TPA. The range is wide, from under $3,000 TPA for low-cost brownfield expansions, for example, Tres Valles in Chile for $2,004 TPA, to over $40,000 TPA for projects with structurally challenged economics, such as Pebble in Alaska, at $48,535 TPA. This spread underscores that the active copper pipeline is a distribution ranging from genuinely low-cost brownfield expansions to economically marginal greenfields that will require structurally higher copper prices or government incentives to proceed. Moving on, we now turn to greenfield versus brownfield. The brownfield category carries a median of $13,302 TPA across 15 active projects with studies publicly filed within the last 5 years, a 27% discount to the $18,200 TPA greenfield median. But this aggregate is analytically misleading. The brownfield cohort splits into 2 economically distinct subtypes with opposing cost profiles. Brownfield restarts and redevelopments, where N equals 10, median is $11,114 TPA and minus 39% versus greenfield, drive the aggregate discount. The range is extreme. Greater Duchess in Australia at $666 TPA benefits from planned usage of third-party processing infrastructure, while Upper Miska in Canada at $22,146 TPA and White Pine in the United States at $20,760 TPA approach greenfield costs through full underground re-entry or environmental remediation requirements. Brownfield expansions, where N equals 5, median $22,086 TPA and plus 21% versus greenfield, are less capital efficient. The active expansion pipeline skews toward large, infrastructure-intensive builds, such as Kamoa-Kakula PH3+4, Kansanshi S3, and Prominent Hill Block Cave, rather than genuine bolt-ons. Looking at the greenfield projects, Vizcaquitas and Canariaco rank amongst the lowest Capex intensity projects expected to produce more than 100 kilotons of copper annually. Both projects benefit geologically from being large porphyry systems amenable to conventional open-pit mining. Vizcaquitas benefits from its central Chile location, with lower elevation challenges, the use of a third-party desalination plant, and access to existing regional power, labor, and export corridors. Canariaco benefits from favorable topography and infrastructure access, helping to moderate upfront capital requirements. In contrast, several higher intensity peers, such as Reko Diq and Vicuna, require materially expensive supporting infrastructure in remote locations and increased execution complexity. Okay, now we pivot to scale efficiency. The current pipeline overall does not show an aggregate economies of scale outcome in build Capex intensity. Rather, the relationship is inverse. Median intensity increases from $15,860 TPA in the small-scale tier to $19,215 TPA in the mid-scale tier and $24,873 TPA in the large-scale tier, while production-weighted average intensity follows the same directional pattern. This does not mean scale has no value. Rather, the projects large enough to deliver that benefit are also disproportionately greenfield and infrastructure heavy. Large projects can achieve relatively competitive capital intensity, but size alone does not overcome the cost burden of first-build infrastructure and complex development scope in a remote region. Next up, regional variation. Regional cost differentials reflect labor structures, infrastructure availability, permitting regimes, and deposit characteristics across jurisdictions. Australia is the lowest cost region in the active pipeline, with a median build Capex intensity of $12,587 TPA, supported by a broad mix of projects and lower-cost brownfield expansions. Africa's overall median of $18,363 TPA sits near the global median, though this masks a wide split between low-cost greenfield projects and higher-cost brownfield expansion assets. Europe remains the highest cost region at $28,333 TPA, while also hosting the fewest pipeline projects. South America ranks second highest in Capex intensity as its pipeline skews towards larger-scale greenfield initiatives. And last, in our discussion of build Capex intensity, is factoring overruns. Headline: Capex intensity understates effective delivered costs in an industry where budget blowouts are frequent and has the potential to completely erode a company's rate of return on its invested capital. A 2024 McKinsey study highlighted that 83% of recent major mining projects had Capex overruns of greater than 40%, while mega projects above $1 billion in Capex saw cost overruns at least 79% higher than initial budget items. These values line up with a 2015 study completed by Export Development Canada, which reviewed 78 mining projects globally and noted on average a 37% cost overrun, with a subset of 22 copper projects within its population averaging 40% overruns. Applying a 40% overrun adjustment to our median Capex intensity gives us a value of roughly $25,480 per tonne. Now that we've covered build Capex intensity, we will focus on acquisition Capex intensity. If build Capex intensity measures the cost to construct a tonne of new annual production, acquisition Capex intensity is what the M&A market pays for an equivalent tonne of existing production. Across 88 identified transactions of copper producers completed between 2000 and 2026, aggregate EV roughly $245 billion, the median acquisition intensity observed is $17,629 TPA, and the production weighted average is $24,754 TPA. Acquisition intensity has moved with the copper cycle through the years. The 2000-2004 commodity trough produced a distress floor median of $2,831 TPA. The 2005-2009 supercycle lifted intensity to $14,362 TPA on increased deal activity, headlined by Freeport Phelps Dodge at $22.9 billion and $31,087 TPA, and Teck Dodge Ayor at $3.6 billion and $33,126 TPA. Notably, 2008 produced zero transactions as the GFC froze activity entirely. The absolute cycle peak observed was 2010-2011 at $30,548 TPA, driven by Chinese state consolidation and Mitsubishi's Anglo-American Sur stake, $22.0 billion and $85,371 TPA. Priced for 20-year supply security, post-peak normalization saw the 2012-2014 median moderate to $19,677 TPA. The 2015-2019 copper downcycle registered $14,131 TPA, though this masks wide internal dispersion across government-mandated divestments, distressed PE acquisitions, and recovery phase transactions. The current 2020-2026 period, including deals such as Anglo-Teck, $22.0 billion and $52,164 TPA, and Rio Oyu Tolgoi, $10.3 billion and $63,316 TPA, has rebounded to $25,182 TPA. Yet at $25,182 TPA, the current cycle median remains roughly 18% below the 2010-2011 peak, challenging the assumption that energy transition tailwinds have repriced copper M&A to record multiples. Regional patterns reflect structurally distinct markets. Latin America is the deepest and most cycle-rational copper M&A market, exhibiting a current median that has not yet repriced to energy transition premium levels despite hosting the world's highest quality development pipeline. Africa's apparent premium is almost entirely attributable to the Mutanda transaction series. Stripping those deals compressed the continent's overall median to roughly $12,400 TPA, the second cheapest region. Europe commands a persistent scarcity premium driven on the thinnest deal flow of any region. Asia-Pacific statistics are materially distorted by Indonesia's politically mandated Batu Hijau divestments, which account for 5 transactions priced by government policy rather than market forces. North America's structural discount reflects mature, declining-grade assets and high operating cost structures, rather than jurisdictional risk. Deal size shows the same inverse relationship as scale tier on build intensity. Transactions above $5 billion carry a median of $46,600 TPA, which is roughly 7 times the sub-$500 million deal cohort median intensity and reflects Tier 1 scarcity pricing versus distressed or subscale assets. At a current median of $34,783 TPA, listed producers trade at a roughly 38% premium to the 2020 to 2026 M&A median of $25,100-$82 TPA when valuing current publicly listed copper producers using the capital intensity framework. The production-weighted average divergence is starker at $74,852 TPA, roughly 3 times the production-weighted average long-run M&A acquisition intensity. The metric is pulled heavily by Southern Copper, $161,971 TPA, and Antofagasta, $79,073 TPA, which trade above both the anomalous 2010 to 2011 M&A peak and recent megadeal valuations. These are better understood as scarcity-priced megacaps than representative data points. Mid-cap names, such as Capstone, $33,764 TPA, Teseko, $35,801 TPA, and Atalaya, $24,398 TPA, sit closest to M&A implied fair value, while microcaps such as Eris, $6,754 TPA, and 29 Metals, $16,203 TPA, remain below the historical acquisition floor, highlighting the wide valuation dispersion within the listed universe. Now we shift our focus to the concluding question of our analysis: build versus buy. Based on all of the analyzed datasets in our report, here are 4 key insights. Insight number 1. Brownfield restarts and redevelopments are structurally cheapest. Brownfield restarts and redevelopments carry a median Capex intensity of $11,114 TPA across 10 projects, a 39% discount to the $18,200 TPA greenfield median. At assets with infrastructure, workforce, and established site permits already in place, recapitalizing stranded or curtailed production offers capital efficiency that no other route currently replicates at scale. Cactus, in the USA at $10,878 TPA and 89.8 tons of annual production, and Metlisle, Australia, $8,542 TPA and 22.2 tons of annual production, are representative mid-range examples. Brownfield expansions are relatively less capital efficient. Median is $22,086 TPA with 5 projects, but remain a cheaper alternative to current M&A valuations. Insight number 2. Historical acquisition median intensity sits below current greenfield median build intensity dollars TPA basis. The overall acquisition median of $17,629 TPA effectively sits at a slight discount over the full cycle relative to the active pipeline greenfield build median of $18,200 TPA. Greenfield build economics appear most compelling when compared to the mid to large deal segments, where acquirers are paying a meaningful premium to the cost of replicating equivalent production through development. The $1 billion to $5 billion cohort, with $20,877 TPA, sits roughly 15% above the greenfield build median, making quality asset M&A increasingly difficult to justify on a pure dollars TPA basis versus building. The $500 million to $1 billion cohort, at $18,294 TPA, is the exception, sitting at parity with the greenfield build median, highlighting that disciplined acquirers in this bracket can secure producing assets at near replacement cost. Insight number 3. Through 2020 to 2026, acquisition intensity has inflected above greenfield build cost. The median acquisition intensity for this most recent period is $25,182 TPA across 23 transactions. The 3-year rolling median Capex intensity has risen to $26,035 TPA, indicating acquisition premiums are currently roughly 40% above both the greenfield build median and the long-run acquisition median. Increasing valuations are being driven by tightening Tier 1 asset availability as majors consolidate the producing universe and strategic pricing for jurisdiction-secure copper given energy transition demand. The inclusion of transformational portfolio deals, such as Anglo American's Teck Copper acquisition at $52,164 TPA and Rio Tinto's Oyu Tolgoi at $63,316 TPA, materially lift the period average, but even after stripping these premium transactions, the 2020 to 2026 period median, at $21,019 TPA, sits above both the greenfield build median and the long-run acquisition median. The public market has re-rated further still, as production-weighted average valuations under a Capex intensity framework have appreciated roughly 60% since the start of 2025. Names that traded at sub-$17,000 TPA have re-rated strongly over the last 18 months and currently trade near parity with median greenfield build cost, while a handful of names have re-rated beyond, up to median acquisition intensity costs. Conversely, microcaps such as Eris and 29Metals remain below the historical acquisition floor, representing pockets where listed market pricing has not yet converged. Insight number 4. Headline Capex intensity understates effective delivered costs. Applying a 40% overrun adjustment supported by industry studies to the active pipeline greenfield median of $18,200 TPA implies an effective delivered build cost of approximately $25,480 TPA, just 3% below the 2020 to 2026 acquisition median of $25,182 TPA. This risk-adjusted parity means the build advantage is not structurally guaranteed. It requires execution discipline to materialize. For capital allocators, those 4 insights translate into 3 strategies to help answer whether you should build versus buy today. 1. Target brownfield restarts or redevelopments where it remains available. 2. Focus on building out high-quality greenfield developments with proven economics and manageable execution risk, targeting sub-$20,000 TPA delivered cost. 3. Pursue selective M&A within $500 million to $1 billion, where disciplined acquirers can secure producing assets at near replacement cost. Another option is the sub-$500 million cohort, where pricing dislocation relative to replacement cost remains compelling, though with the acceptance of the trade-off of asset quality and scale constraints. And that wraps up this article audio. Thanks for listening. This narrated blog content is for informational purposes only. The information contained in it is not legal, tax, or investment advice. FactSet does not endorse or recommend any investments and assumes no liability for any consequence relating directly or indirectly to any action or inaction taken based on the information contained within this content.